Cute. So I am Tehsin Kahn for those who don't know me, and I'm the founder of Growthpad. So today I'm going to talk about my journey into what I'm doing now, the services that we offer, what are capital allowances, how it qualifies, and what sort of assets qualify and how we can help. So I've worked in tax since 2008. I've had a journey working with Little John, now part of PKF, Grant Thornton, EY, and Markel Tax. On that journey, I've passed some tax exams, and I've also written 3 books for Indicator. They're a publisher in England and Europe. And we've also recently done a review of a special paper that they're bringing out. So somebody else wrote it. We just had to review it to make sure that it's all correct from a technical perspective. So hopefully in the next few weeks, you'll see something out on LinkedIn showing that has been released. 8 years ago on Sunday, because Sunday's our anniversary, I started Growthpad, and we provide niche taxes that other accountants and most other tax advisors do not touch. So these are services that we offer. So the first service that I started issuing was R&D tax relief. So R&D tax relief is a tax incentive to help innovative companies recoup money they've spent on science and tech projects. And I also then started capital allowances, which is tax relief on capital expenditure on assets that are embedded into property for commercial property. And we also have a network of associated people who provide the services of land remediation, patent box, VAT advisory, grant funding, international tax, and corporate restructuring, including exits and acquisitions. So for today's session, I'm going to focus on capital allowances. I'm going into more detail about that. So I get asked what are capital allowances, so I'm going to say some basic things here. So sorry if you already know this. So when you purchase something, um, excluding land, what usually happens over time, it goes down in value. So what your accountant does is it predicts how long that asset will last for. So let's say if you buy some machinery, it costs, let's say, £10,000, and the accountant thinks that machinery will last 5 years. Well, in that case, the machinery will depreciate at 20% every year. So every year, so for the first year at £10,000, 2 grand will be deducted as depreciation. HMRC don't like this because what it means is two different accountants can value the same asset at a different depreciation rate. So one accountant might say, oh, that depreciates at 20%. Another accountant might say, oh, that depreciates at 30%. So what HMRC did was they standardized depreciation for assets and called it capital allowances. So now all these assets are standardized and how you claim them, and each type of asset has its own value of what you can write off essentially every year as a tax deduction. Now, usually I expect accountants to be able to claim for any items such as like machinery, cars, and things like that. Where we help is where items are embedded into a building, such as electrics, heating, lifts, plumbing. We help identify those costs that the accountant usually misses. So if you've heard of capital allowances before, you may have heard of the analogy where if you tip the commercial property upside down, everything that falls out of that property, we expect the accountant to have those correctly allocated for capital allowances. Stuff that's still in the building and attached to the building, they usually miss that stuff, and that's where we come in and help. So what qualifies? So the first condition is that a trading business must own its own premises. So it could be office, factory, hotel, retail space, pub, restaurant, various things. It also qualifies for people that own UK property businesses. So where there could be an investor and they own commercial property, and that commercial property pays market rent as well, if it's let. Also includes if you've got a holding company that owns uh, the property, and you've got a trading company and there's a commercial arrangement there, you can also claim for the holding company too. And we've got a deadline for end of March this year to claim for furnished holiday letting businesses. So that's all the Airbnb stuff. I can go into like technical definitions what a furnished holiday letting is, but there's no point doing it here. A couple of things that you should be aware of is a leasee can also make a claim if they've spent money on the property. And HMOs and property developers are specifically excluded from claiming unless their business owns their own building and uses their building, and it's not treated as stock, which they're going to sell for a profit down the line. So there are three types of claims. So the first is when there's a purchase. So when someone purchases a commercial property, or when there is a long lease with a premium paid. The second is where there is an extension or a refurb of a commercial property. And the third type is a mixture of both, where there's a acquisition of a commercial property and then a refurb or extension. Now, you're probably thinking, why do we need a specialist doing this work when we've got an accountant or the accountants exist? So think of a scenario where let's say I purchase a commercial property. Um, how would my accountant know what embedded assets are in that property? Okay, let's say if they go into the property and visually see these, are they qualified enough to value each asset or properly identify it? They're not. That's completely out of their comfort zone. So what we have is we send a surveyor in, especially on complex cases. They can see the assets that are integrated into the property. With that information, they come back to our capital allowance specialist, and using an extensive database from BCIS and RICS, we can reverse engineer the costs according to legislation and do a capital allowance claim that way to make sure that everything is claimed and it's also allocated to the correct type of asset. So these are typical assets that are embedded into property that you can claim for. So you got central heating pipework, radiators, electric heating, wiring, power sockets, vinyl flooring, kitchens, nurse patient call system, CCTV, lifts, and hookup points for like water and electric points. Now, I think this is a good idea to mention specific sectors so you can clearly identify what sort of assets they will have. So like, for example, in an office, they have networking, data points, trunking, signage, emergency lighting, raised access flooring, sometimes suspended like ceilings, fitted desks, especially in reception. And those are the sort of things that we've missed for the additional relief. For student accommodation, you'll have communal areas such as a gym, reception, electrics again, auto car park barriers, signage lifts. Excuse me. For care homes, you'll have a nurse patient care call system, emergency calls, and stair lifts. In hospitality, you'll have the splashbacks, ambient features, entry systems, stages, and like passenger and goods lifts. For larger industrial properties, you could see complex electrics machinery, compressed air lines, grain silos, and dock levers and things like that. So hopefully that will help you really identify anyone that could benefit from capital allowances. So when I started the capital allowance service, I didn't realize that this, what I'm going to talk about now, was an issue. I was really focused on refits and extensions. But after conversations with multiple large regional law firms, this is a problem. So when a commercial property is sold, there's a form called the Section 198 that needs to be completed properly. What's been happening is lawyers and sometimes with the help of accountants have been putting in a nominal number in there. It's usually two for some reason, but that is completely incorrect. And I'll give you a scenario why that's incorrect. And I'll use large numbers because I think you'll have more of an impact. So let's say, for example, there's a sale, someone's acquiring a £5 million property, and they have £1 million of embedded assets within that property, and the lawyer puts in the nominal two. Well, what that means is the purchaser can now only claim £2 worth of capital allowances, and they've missed out on 250K of tax savings. So once speaking to these commercial lawyers, and we found that this is a problem, and we're really pushing, speaking to as many commercial property lawyers as possible. We're agreeing a process where when there is a commercial property being sold, that we review the contracts. And that's at no charge because for us it's potential cost of acquisition. So we benefit, the lawyer benefits, the client benefits. So that's something that I'm urging commercial property lawyers to look at. So if you know any commercial property lawyers, please put them in touch with me because this is quite a big thing and it might blow up in a few years' time once litigators get their hands on it. So we help lawyers, accountants, and businesses in the sectors of, when they have offices, student accommodation, care homes, hospitality, gyms, medical centres. And we also help property investors. I said to you before that property developers can't claim, and that's true. But what they can do is whenever the commercial property is sold, the buyer can claim. So they need to make sure that Section 198 is done properly. So it's worth having a chat with property developers to make sure that process is accurate and correct. And also, they can also lean on a return of ROI, a quicker return of ROI, because if it's a experienced investor where they've already got a portfolio and company and already got profits, then they can recoup their ROI quicker because of the way that capital allowances work. So if you want to book a chat with me, there's QR code. You can scan that and book something in. Thank you. And does anyone have any questions?
I have some questions.
Yep. I'm just gonna close my screen so I can see you. Oh, no, I can see you. Yep.
Why is it, Tehsin, that it has to be own the building rather than a long-term lease of a building?
Cool. So the ownership of the building is just the qualifying criteria. So as long as the building is owned by someone, by a qualifying person, so that could be an investor or a business, then the person that's leasing the property can still claim.
Fantastic. No, that gives good clarity. Thank you.
Yes, thanks for that. Great. Absolutely brilliant. Really helping on from our meeting this week. When accountants or the client thinks the accountant's had a look at it and done a little bit, how easy is it for you to just do a second review, or do you tend not to bother? I'm sort of curious because I know accountants can do half a job on certain
Yep.
things.
So,
no disrespect, Kim.
so we can do a review probably in about 10 minutes.
Okay, so
because
that's not
we've got access.
onerous then.
Yeah, because access to the accounts, we can get tax comp off the accountant. We can look at land registry, and I basically hired someone from a competitor, and he's got lots of experience in this. So he's been doing this for a long time, so he knows how much a typical claim would be across sectors. So if he sees that something's low compared to where his baseline is, then he knows that's worth a review.
Okay, brilliant, brilliant.
It's all
That's
made me quite nostalgic because I used to be a normal accountant and I gave a lot of advice on capital allowances and I knew all the leading cases from 40 years ago. Atkinson Leeds Permanent Building Society, which was to do with removable etched glass screens, or there was one to do with a standard of football ground, which was defined as plant and could be depreciated by capital allowances, and dry docks and so on and so forth. You've developed it into a fine art, so congratulations. I don't know any tax anymore. I have an accountant because I can't keep up anymore.
Cheers, Chris. I don't even do my own tax, to be honest, Chris.
Tess, quick one. On your furnished holiday letting,
Yep.
Given that there's a deadline of March, how far back can you go? How many tax years can you actually go?
I say it's always worth having a conversation. So we've done a claim for, it's not finished holiday letting, it's a coatings company, and they purchased a property in the 1980s and they still got a tax saving. So it's always worth having that conversation. So we can go back quite some while.
And with the deadline looming, how much time do you need to be able to check back over, let's say, the last 10 years?
If the accountant, the client, and potentially the previous owners and the lawyers are all quick, the quickest we can get one done is probably 2 weeks, just less than 2 weeks.
Okay. I'll put you in touch with someone.
Awesome.
I've got another question. Tessin, I've got a client who is they're a trading company at the moment. They also own buildings, commercial buildings, that they lease out for other clients. And they are looking to sell the business on, which they've not had a huge amount of success. However, they may be closing the trading business and keeping the property business going within the same business. If they haven't done something like this, would this be an ideal time whilst they're still trading to be able to benefit from the embedded capital allowances?
It's worth having a chat now so we know the proper ownership structure. We know how they're planning on using the funds after disposal of the business, and it just helps us formulate a plan with much more clarity. So it's worth having a chat now.
No, that's fine. Okay, no, I'll see if I can get a hold of them this week.
Awesome.
Tessin, I'll just make one comment. So I do tax investigations and disputes, so I get involved in the kind of murky world of tax avoidance and things like that. There are very few government-blessed reliefs that HMRC recognise and approve and process, of which yours is one of them. So it is a really good way for businesses to look to reduce and mitigate their tax liabilities in a completely legitimate way without doing anything what might be perceived as underhand by the tax authorities.
Cheers, Richard. The unique thing about capital allowances is it's been established, I think it's since 1945, around that time. So it's been around for a long time. What that means is there's substantial case law backing up the legislation. So things are much more clear compared to, let's say, I'll say we do R&D tax relief compared to R&D tax relief, where there's not much case law. So there's still a lot of work to be done with claimants and HMRC. So yeah, capital allowances is much more better. Appreciate your comments, Richard. Is that it?
Yep. Thank you all. I think in the spirit of the LMPs, you did ask for intros in your presentation. Can you just remind us, Tess, of what they are, please?
Yep. So the three main ones are accountants, commercial property lawyers, and property investors. They're the main ones. Also, with like care homes, people that own care homes, medical centers, gyms, business owners with the premises, also they would be very useful to us. Thank you.
Let's have a catch up, Tess, because I think I can sort of wade in with a fair few there for you.
There's no surprises there, Colin. Thank you.